Hey everyone, welcome to the Crypto Leviathan podcast. I'm your host Dalibor. This is my co-host Andrew. Welcome to the show. And today we have two special guests. They're part of a major crypto lending platform, and I'll let them do their introductions. So, Bill, do you want to start off introducing yourself?
You bet. I'm Bill Wolf. I'm Chief Investment Officer of Archblock, which is the corporate parent and curator of TrueFi that we're going to talk about today. Let me hand it over to Michael.
And I'm Michael. I lead the marketing efforts of TrueFi. It is the premier and first unsecured lending protocol in DeFi, doing about $2 billion of originations to date. Been around since its origins, and excited to tell you guys all about it.
That's awesome. So let's just kick it off. How did you guys get into the crypto space? Tell me a little bit about your background and what excited you to actually move into this space.
Bill, why don't you take it away?
Happy to. So my background is traditional finance. I was an investment banker for 20 years. Then with some partners, I founded a aviation credit lending and leasing business. And so I've been around credit and lending for my whole traditional finance career. And the way I got into crypto was what I would call long-term FOMO, because I'm old enough to have been around when the internet was developing. And while I had all the right instincts to say this is going to be an important technology, I did not go there. I stayed in traditional finance, no regrets. And so when the crypto and blockchain space started developing, I had some really good friends who were good technologists, and they said, here's the chance to cure your 25-year FOMO. And so I became an investor in TrueFi and an advisor. And then when my last gig, we sold the company, I was looking around for what I wanted to do, and I realized this was the most exciting thing I could do. So I joined TrustToken, TrueFi, and we're now rebranded as Archblock. So that's my story.
Sweet. And mine was more on the sort of founder path. I had been sort of building businesses here and there. At the time, in between a business, I was editor-in-chief of a sort of a startup publication called Startup Grind. I was getting a lot of media around crypto coming through, a lot of contributors writing about crypto. Started wondering about it, tried to do a startup in the space. Actually ended up being roommates with our former CEO, Raphael. And somewhere along the way, decided to take my talents in marketing to actually help out the space of crypto. So did a bunch of ICOs and other projects at around 2017. Probably a few you've heard of: Compound, TrustToken, obviously, Algorand, and a few others. I got busy with those as a marketer, and then joined full time when it felt like I wanted to sink my teeth into something and actually be with a company through its journey. Joined TrustToken around about 2020 or so, 2019, late there, and launched TrueFi with them and been there since.
It's awesome. Well, you gentlemen have a fantastic background. So, Bill, you made an interesting comment, which I think I want to emphasize. What similarities do you see with the evolution of the internet in the 90s and crypto right now? And what differences do you see?
Well, great question. So the most important, from our perspective, compelling similarity is in the same way that very smart people who had good technology, long-term vision, saw that the internet in the 90s, that it was inevitable, it was going to be a very important place for information and commerce to happen. Those same, literally some of those same technology prognosticators, but obviously a whole new generation as well, have looked at the blockchain, and they are convinced it is inevitable that it is going to be the place to move money and manage and transfer money. And so while, obviously my statement implies that, there has been 20 years plus of hardcore development on the internet side for that inevitability, but look where we are today. We argue that it's going to happen faster in that inevitability. So that's the biggest similarity, is that inevitability of where it's going to be a very important place where things are going to happen. Some of the differences are this type of programming is much, much harder. And so while I'm not trying to anyway, put down folks who were on the forefront and developing all the important things that we now, stand on their shoulders in internet programming technology, again, technologists, this isn't my opinion, say that what we're facing now is a much harder programming problem to solve and problems to solve than the internet was 20, 25 years ago when it was in its really steep curve. So those are the biggest ones I would highlight.
Mm-hmm. And if I can double down on that, I'd say it has this kind of funny similarity to like being the era of server racks and infrastructure back in Silicon Valley. Like it is that feel right now. Like we're so early that stuff's breaking and you got to do it all yourself and you got to run your own nodes and what have you. Some of these things. That's a good sign that we're in early and pioneering a field. So that's really great. And then the thing to Bill's point, to kind of give a little further nuance at it, why is it harder? I think a lot of the reasons it's harder is because when dealing with money, you're dealing with regulators. So you've got this overhanging complexity of now dealing not just with the complex movement of atoms to bits, as we did just in the age of Silicon Valley, but also doing so in a regulated space. It's a heck of a Wild West to be playing in.
So that brings us to an interesting segue. So you touched a little bit about the regulator aspect, and that's like the talk of the industry, right? I think there's an article that came out today saying that the US is looking to basically ban algorithmic stable coins. So definitely no one's certain what this landscape is going to end up. How do you guys actually keep track of it? Because it seems like it's changing daily at this point.
Mm-hmm.
So, I'll start off, and I know Michael will have something to add on this. One of the primary ways is we're part of the Blockchain Association, and so we are a member of that industry group and other industry groups that are interacting real time, and we are interacting real time with regulators and trying to be in front of them so that we can understand their concerns, but also, very importantly, just educate them. Because think about how far behind still Washington, D.C. is in regulating the internet. Just basic internet functions are still way behind. They are woefully behind in what some people argue from a financial innovation. This is as important as really old innovations in finance, like dual entry accounting. That was invented by some monks in the Renaissance. Central banking invented in the 1700s by some families. And so it's that important of a thing. Think how far behind they're going to be on that just by definition, because it's moving so fast. So we're just trying to educate them. We're trying to plug into these industry associations. And there's one other overlay I would put on it, is that we're also trying to make sure that whatever rules are out there, we are 2 or 3 steps ahead of. Now, there aren't that many rules out there, and that's one of the hardest things, is we're trying to walk in a direction we don't know which way to walk sometimes. That's part of the overlay.
Yeah, I add in that I've actually I've been a part of a number of startups, a number of industries, in media and various tech fields and what have you. But I've never been in one where the legal department has played such a major role. At first it was a little constricting to be a marketer. My job to sort of hype things up a little bit, and to have to now run things through sort of the filter of the legalese and the languaging to make it appropriate. But it is very much the case that having in-house legal, having people dedicated to building whatever it is that someone in this field might be doing, alongside professionals who have their eye on the industry, is a key thing. So maybe that means having someone with legal expertise on the team. Maybe that means being part of the associations, to Bill's point. There's a lot more of a focus to that, both at our company and pretty much, I would suggest, at any other in the crypto space. And beyond that, this is a funny thing, but you learn a lot in their arena. So the thing that we're probably doing the most to stay abreast of all these developments is we're actually building in the space. We're building in the lending space and building the financial infrastructure. We're building in the asset space with the stablecoins that we run that are transparent. And I like to think we're leading there on the transparency side. Pretty much the tip of the spear. And so too on the accessibility of these things. We're serving the world while staying confidently in line with all appropriate sanctions, all appropriate regulations. So it's a tough needle to thread, but being in the arena really pushes you to actually figure this stuff out. So we're not just observers, we're actively participating. That's probably the best way to keep yourself involved, build.
Absolutely. So there has been some criticism lately that crypto is increasingly becoming more centralized and government regulated, and a lot of the early adopters, kind of like in the internet, were those, libertarian, rebellious types that wanted to challenge the status quo. How do you see that balance being struck? Because obviously governments want, to regulate this, and there's people in crypto right now who want to push back against this. What direction do you see this, and how is there going to be a balance achieved?
Bill, do you want to take a stab at it?
I'll take a stab at that. We think a lot about this, and we talk a lot about it, and part of that is a separation that we're going through right now as an entity, or with you or as entities. Our DAO, TrueFi, is an increasing process of becoming independent from our corporate side. We want it to be done as quickly as possible, but there's a lot of steps we have to go through to get it done. So part of how we're going to keep that innovative, on the edge, but not over the line, is by having that organization, that DAO, be the responsible party for that innovation and pushing things. On the flip side, Archblock, our corporate entity, we're going to be focused on servicing institutional customers, and we're going to be focused on being much more traditionally oriented and regulatorily, 100%, and we'll be followers as opposed to leaders on that innovation. So that's part of how we're dealing with it, and we have the freedom to do that from a regulatory standpoint, because the DAO is not a U.S. entity. It is not governed by U.S. laws, and that's not to say we can fly in the face of them, but it means we can be judicious about things that we choose to be as our sort of guiding star, et cetera. So that's part of how we're dealing with it and creating that balance. And naturally, folks are gravitating to the area where they think they can add most value, and that's why Michael is gravitating towards the DAO, and old guys like me who grew up in a completely regulated financial industry, I'm gravitating to the institutional side.
Yeah, sure. So it's a good way of like pocketing risk on, risk off. I looked to a company, it's a great analogy for Uber, because I think that's what the industry is doing, where you create a product that is so in demand by its customers, its users, that it pushes the regulators in a direction, right? So I think crypto is doing that in an interesting way. But while Uber was, effectively risk on and risk off in the same place, both the, compliant and regulated version of their business, but also, sort of their contractors and the stuff that they were doing on the sort of leading edge of compliance were all contained in the same pocket. What you're seeing in crypto is that has split. So the risk off side of things serves as the anchor in the real world under current regulatory regimes in, hopefully a place with a fairly thought out regulatory structure. Maybe that's a Singapore, maybe that's a Delaware, or what have you. And then you have some of these sort of crypto anarchists, what have you. I'm speaking a little to the extreme here, but you have the folks who are really building this and building it seriously, cutting to places like Gibraltar, the British Virgin Islands, other areas like Zug, maybe in Switzerland. It's kind of a funny thing where, like, in some way, regulators are playing a game where they're creating a marketplace too. It's a regulatory marketplace. And these real innovators who might in fact create a lot of value, and who might in fact let themselves have some of that value captured by regulators, are going to pick the regime that is most in line with what they want to build. So there is this interesting thing that you might it's odd to think about, but governments are in fact competing. They're competing to be the right regulatory regime for a crypto innovator to locate their risk on department. Right. But I do really respect what Archblock is doing. And what we need to do is we need to have that anchor in the real world, in a place with pretty sound regulatory regime, and a pretty expert team of Wall Street folks who know what they're doing, and who will, white glove the institutions with the money and the power to actually dip their toe in the pond. TrueFi and many of these DAOs are happy to pioneer in that risky space where maybe we don't know what health benefits we're going to get, and what jurisdiction we should be reporting certain things to, and all, but we're figuring this stuff out as we fly, and that's, I guess, part of the startup journey.
So just to elaborate on that, so you said you're looking to split it into two entities. Where do you draw the line between what's the responsibility from risk on and risk off, like those two different departments? How do you manage that?
Yeah, good question. Bill, do you want to talk a little bit about what Archblock's scope of work is?
You bet. So on the Archblock side, what we're trying to do is build an institutional SaaS offering and service offering that sits on top of TrueFi as the base layer of open source code to manage lending on the blockchain. And so we're on the regulatory front, et cetera. we've partnered with a U.S. broker-dealer who has permissions to deal and settle in digital assets. We are every day talking about all of the, I won't go through the whole list of compliance activities and regulations that we have to be on sides with. And all of that is so that we're working to attract those institutional portfolio managers, which is our most important customer base, but also the institutional lenders and investors who are going to bring capital to the marketplace, so that they all feel like this looks just like home, but with much better technology, et cetera, around it. And so that's what our orientation and focus is, and who our customer base is. And they won't play if we don't have that as, so that's kind of that's a given. That's not a nice to have.
Yeah. And I want to make an analogy here to, I think, the logistics sector. I think it's a good analogy here to make. Logistics, you think of, from production all the way to sort of last mile, and there's a lot of stops in between. And there's the last mile. Last mile is super heterogeneous, right? It's not homogeneous. It requires a lot of local nuance, cultural nuance, logistical nuance, what have you, right? When you think of that, it might be UPS in the United States, it might be a tuk-tuk driver in Southeast Asia, or it might be, hand delivery in, say, London to your doorstep. Those nuances are what I think are the expertise of Archblock. It requires, this nuanced field expertise of speaking to institutions, family funds, what have you. And it requires, a strong Rolodex, institutional know-how, expert team. And the focus is a lot more on relationship building with all the different players to make that last mile happen. That's how you get those inflows in. What TrueFi likes to think of itself as is we are more so the logistical side of this. We are the logistical infrastructure. We are the underpinning, we're the freight and the trucking and the shipping equivalent of being able to move money around. We have portfolios, which are like containerization. They're a way to put money into a package that makes sense on chain. We think of, the rails that we've built, the lending infrastructure built on Ethereum, but also on Optimism, and easily scaled to other blockchains as sort of the shipping lanes. Right. So TrueFi thinks of itself as the infrastructure itself. We are building that financial layer, the infrastructure. We think of it as, idealistically as something that's sort of a public utility, the canals and waterways to be used by everyone everywhere. And I think of Archblock as sort of the last mile provider. It's the white glove service that gets people to actually use the service in the first place. Because, hey, who would we really be using? Would Amazon be as successful without 2-day shipping? Right. It's a hell of a question. And so, that is the difference between, TrueFi without an Archblock, without sort of a last mile provider. It's like Amazon without 2-day shipping. It doesn't have that extra service layer that makes it a hell yes. That makes you order that extra thing you wouldn't otherwise. That makes you try out financial product you otherwise wouldn't have touched or you wouldn't have had access to. So
it's a great analogy.
TrueFi infrastructure.
I'm going to use that with attribution to you, Michael. That was awesome.
Please. I guess it is my job, right?
It is.
There it is.
Yeah. So let's a little bit explain about how traditional lending works, because like a lot of people, when they hear lending in crypto, they don't understand it because they don't also understand how traditional lending works. So can we start with explaining how traditional lending works, and then go into how it differs on the blockchain, and if there's any
question. Put it to the expert.
You bet. Well, all right. So at the highest level, obviously, traditional lending happens through a very small subset of mechanisms. It either happens by people borrowing from a traditional financial institution like a bank, and there are other institutions like that that are traditional lenders, or by borrowing in the capital markets. That means where a company would issue bonds, if you will. So that's traditional lending. And there's one other aspect that's out there in the marketplace, and actually a very important one that we're addressing, which is called private credit or alternative credit. And that's a big macro trend that has evolved over the last 20 to 30 years, because banks have effectively, in a lot of ways, gotten out of the primary lending business. They still lend, but it's actually not their biggest business anymore, lending on a corporate level. And that's what we're talking about. We're not talking about consumer lending. We're talking about corporate lending, or credit lending, if you will. And so if that's what the base layer of lending looks like in the traditional markets, what we're in effect doing is using TrueFi, the base open source smart contract software, to take the place of the capital markets, take the place of the bank, or take the place of the private alternative credit allocator, and create all the middleware infrastructure that allows somebody who has a perspective on credit, who says, there's a certain group of people I want to lend to. I want to use a real example here. I'm a really good expert at real estate lending, and so I want to lend to real estate projects, and I'm going to do it on TrueFi. And so I open a portfolio, use the software to set that up, advertise what my expertise is and what my particular sub-strategy is on that, and then investors can come see that on the TrueFi interface and deposit their money, and then they can see each loan I make as I make those individual loans with extreme granularity, real-time transparency, and open for business 24/7, 365. So that's the big difference between that and the capital markets, which go to bed each night, the banks that go to bed each night, and the private credit allocators who all go to bed each night, or they're only open during their own time zone. So that's at the simplest level, the big difference between what traditional lending is and what we're trying to bring to it.
Yeah, I think Bill really nails the point there. I'm not gonna add too much here, but as far as difference goes, besides 24/7 access, it's also global access to a broader range of lenders than ever before. When you look at some of the opportunities available on TrueFi or available in some of these niche credit fields, these are opportunities largely available to high net worth individuals or expert funds. Partly because it doesn't really make sense to do all that work to offer these deals to these people if they're number one, either not regulated and accredited, so they can't actually invest, or number two, they're not going to put as much capital in to actually make that effort make sense. So TrueFi is one of the first places where lenders from around the world, developing countries, myself, I would never find these kinds of deals myself. So I think a lot about what TrueFi is doing is not just increasing the effectiveness of this stuff by making it 24/7, lowering fees, eliminating some of the things necessary in fund management because now they're handled on chain. For example, reporting is all on chain data, right? So it alleviates the need to do certain things in the same way. The thing that I think is most exciting, effectiveness, transparency notwithstanding, is the fact that it really makes lending and financial inclusion more equitable. It allows folks like all of us in the room and many of the folks listening to find opportunities we would never have access to with yields that are, underpinned by real world value creation, which is also kind of interesting to see in DeFi, and to participate in those things, even without being accredited or without being, a US lender, or without, being in a jurisdiction that, makes this somehow easily more palatable. So accessibility is, I think, a really, really huge play. And I think that, especially with optimism being something that we now being launched in optimism, it makes the fees to lend really low. So now earnestly getting in is cheap and the opportunities are really lucrative. So really, really opening up accessibility is a key play.
I just want to extend a little bit on what Michael said, because you're talking about changing the unit of scale in two regards. One is the unit of scale of the investor, because historically, in this important trend that we're talking about here in alternative credit or private credit, large investors have been putting more and more of their asset allocation into that for the last 20 to 30 years. And the reason for that is because you can have superior returns at the same risk level versus the old classic 60% public equities and 40% public bonds. And so these investors have had access to that. Well, all of us on this call, we don't get direct access to that because you've got to have $25 million and be able to commit it to your favorite credit manager. We love these folks, Blackstone, Apollo, really well-known global credit managers, but you've got to lock it up with them for 10 years and you've got to have $25 million. So the unit of scale of the entry point of the investor has literally gone down to, it can be $100. It could be $5, but then the fees would have to be super low. So that's one area the unit of scale has changed. The other place the unit of scale has changed through using our technology is in the deployment, because there's a reason why Blackstone Credit and Apollo need to take your money in $25 million chunks, is because they're using traditional rails to manage that credit, and they need a fund to pay for all the infrastructure they need. They need a fund to be $500 million. That's like, that's like base level. Ideally, they want to raise billions of dollars in a fund. Well, with our technology, someone who has a niche credit perspective meaning a place where credit is needed and they can underwrite it efficiently, can use our software, and you could have a $10 million fund, do it efficiently, and serve a market that is unservable by the capital markets. And so our technology is really dealing with scale and redefining what scale is, both at the investor level and at the deployment level. And that, I'll tell you, is one of the most powerful things that we're working on right now, and why this is going to be inevitable, to going back to what we talked about at the beginning.
I love this idea. And just to give in context, so I'll give an example here for anyone in our audience who doesn't understand this entirely. So right now, like, I lended $80,000 off to a company who's building a property. And I have access to this because I have connections in the industry, and they approached me due to my reputation. And as someone who just has like $5,000 in a bank account, you don't have access to this, because why would they take money from you? They take it from me, deal with one customer. But this on a blockchain now, people could pool all their money together and give it to you as a loan, and the network confirms and validates where all this money is coming from and where it all needs to be paid out from. So that's where the power is, right? The ability of smaller guys coming in and participating in these deals that have much higher returns, right? Because when you do private lending, it's like 10% interest. You can't get that anywhere in a bank. You can't get that anywhere in the public institution. So this is where the value is of this product, just to make it clear.
That was awesome. By the end of this, we may offer you a job, so be careful.
So now going back to that fractionalization. So obviously the reason why the barrier currently in this space is high fees. Basically, you have to go to a lawyer, get the contract written up. How are you standardizing that process? Because I think that's going to be the key here, getting that fee down really low.
Okay, so boy, there's a lot in your question. Let me try and keep this at a high level. Well, we're providing on the Archblock side, and this is where we really can add a lot of value, because back to Michael's excellent analogy here, what you're talking about now is kind of last mile stuff, not the big pipes that TrueFi is running. We're creating standardized versions of contracts, marketing materials, regulatory filings, et cetera. And that's part of what we're going to offer to our portfolio manager customers, so that, they don't have to start with a 200-page master loan agreement. They can start with our very streamlined one and then add in the components they need. Now, today, we're doing that on a very analog basis. We're building the technology so that you can come in and say, oh, you're doing real estate, you tick that box, then we know you need, these following paragraphs to be in your document. So that's where we're heading, so that we're creating these standardized, reusable objects, if you will, that people can use. And so that's what we're doing to create, so that you take those costs out. That doesn't mean that there aren't still going to be lawyers involved, and there's still going to be some tough problems to be solved. But the vast majority of people don't need that in order to manage credit, in order to deploy it. And so again, we're taking cost out through creating standardization and easy access for people to use that. But there will still be edge cases in that where you're not going to take those costs out, and those folks will need to have certain scale in their portfolios to make it worth their while to be on the platform.
Mm-hmm. Without getting too deep into the weeds, I would make the analogy that using TrueFi for lending is the difference between sending email using the traditional post office with having a hard paper copy and sending that out, which is the equivalent of having a fund and managing reporting and sourcing investments through your network, which will obviously take a lot of money and time. It is that laborious and old school process of sending letters versus being a networked infrastructure that allows you to send emails. And to dig into a little bit more, the example I think that's most interesting and most useful here is, for example, sourcing liquidity. This is something that TrueFi does in ways that are just unbeknownst to fund managers today. Today, as a fund manager, there's solicitation laws, there's issues around who you might be able to onboard. TrueFi makes this so dang easy that whether you choose to run the portfolio on TrueFi's native website, which will allow you to source liquidity from our thousands of lenders, or you choose to use the infrastructure we've built to run the fund on your own website and underpin it with so TrueFi infrastructure, and effectively makes it as accessible to lend into your portfolio as if you were doing an Amazon checkout. a few steps of the process. We still have the infrastructure layer with support of Archblock or other service providers that might do the same thing later, do KYC and lender selection and what have you. But suddenly you've gone from having a institutional fund that you can only market to a select group of participants who are accredited in a particular jurisdiction, and you then go through the laborious process of going through your Rolodex and sending out targeted emails to source millions of dollars. You can now effectively list your portfolio as if it were an SKU, on an e-commerce website, as a product you offer to the retail lender who meets your criterion. There are many more nuances to the things that the infrastructure provides, but I will basically, again, simplify it to increases accessibility to lots more lenders. It adds extreme transparency, which is a good way of avoiding the kinds of credit crunch issues that we've had with some of our centralized competitors in sort of more recent days. It's just hard to know where your money's going if the books are not transparent by default. So it implicitly makes it a little more safe to lend on chain. And then finally, it does make the financial products cheaper to run because you now have fewer business overhead components. Whether that be a glass office in New York to run your fund out of, or it be the simple laborious act of deal sourcing and lead source and sort of investor sourcing. So again, cheaper, more transparent, and more accessible is what the infrastructure provides without getting, again, too deep into the weeds.
Another thing I've thought of that's also pretty interesting. Now imagine like you're a smaller developer in real estate, or you want to start a new business. You can basically, hey, I want to lend here, put it out on this platform. And previously, I don't know if you guys have ever gone through the process of getting money from a financial institution. It's ridiculous. So their criteria is like you need to operate for 2, 3, 4, 5 years of business, consistent cash flow. And I just think having another option, yeah, you'll have to pay higher than the banks will offer. Of course, that's why you're here, right? Because you can't get funding elsewhere. But I think having that option, right, versus having to know angel investors or specific individuals, I think is a great way to get funding.
Yeah, maybe we could chop that up a little bit, which is it's an interesting question of like, who can borrow, right? And when we started this thing, now 2020 November or so, the thing to really keep in the back of your mind is, sort of heading to a bull market, high times. A lot of market makers wanted to put capital to work, and there's lots of places to put money to work. And hey, it was the kind of era where you could throw a rock and things would, have high APYs that wouldn't fit on the screen sometimes. So without belaboring that point, during that time, the thing that we were keeping the top of our minds is what is an unserved sector of the market that say capital wants to flow into. In this case, they're market makers in crypto were doing great yields at a pretty good risk-adjusted return. And then to that point, the other thing is risk-adjusted return. So where can you like offer financial services and products that are not really being served by the market that have like really, really nice risk-return profiles? And so we did a lot of lending to big institutions in crypto. Right. Over time, things broadened. We started doing more real world lending, especially as the credit crunch hit crypto. It proved out to be really useful to diversify our lending book into things that were, number one, not tied to crypto itself, and number two, not really available elsewhere in DeFi. So that proved to be really interesting. We can go into that. But what's really interesting is like when you come back to the question of like, hey, maybe you're a real estate developer and you want to put a little bit of money to work. Well, cool. And maybe TrueFi in its history, had certain rules of thumb. This is never in the smart contract, mind you. So these are not hard-coded rules, but we had hard-coded rule of, you might be in operation X amount of years and have $10 million AUM. Well, as the infrastructure gets more effective, as more people adopt it, as it becomes more decentralized, these are not decisions that TrueFi is making, nor TrueFi has to serve that say TrustToken, the former company, has to now underwrite. The underwriting is done by portfolio managers. And here's where it gets interesting. If a portfolio manager has a thesis and an effective way of managing a lending book to retail borrowers, or a lending book to, say, real estate investors who are also sort of small, medium businesses investing in, a few properties, they don't have $10 million under management. Well, the infrastructure is getting to the point where it has achieved enough scale that it can support that kind of lending. And because TrustToken has gotten out of the way and Archblock is now just playing a service layer role, it doesn't need to underwrite those businesses. It doesn't have to serve as the bottleneck to get those people on board. So as this stuff scales, yes, we've started with a big institutional play in crypto. We've expanded to institutional plays in real world assets and real world lending. But as we get deeper and deeper into this infrastructure can support all kinds of lending, and we've removed the bottlenecks. We've made it effective to scale, and we've made it really, hopefully, increasingly simple to use. And we've delegated the role of underwriting such that TrustToken and other underwriters that will be centralized and would serve as bottlenecks to help this thing get off the ground and bootstrap it are no longer the bottlenecks. And so long as the community approves you listing it, or if you decide to launch it yourself using our infrastructure, like, have at it. And that's kind of a new thing. You know, there's ever fewer gatekeepers, and I won't claim today that you can get a retail loan to fund your new ice cream truck idea, but it is not far afield to say that if there's a smart way to build that loan and there was demand for that loan, that you could launch it and find some liquidity.
Yep, and that's using the power of decentralization and crypto to fund traditional methods of lending.
Precisely, right.
So let's shift gears a little bit. So how does so let's say I loan money on your platform. How do I get paid? Is it through the crypto platform, through my bank account? How did you guys structure it? And also, how do you handle people who default on loans? Because that's going to be, I think, very important.
Great
Yeah,
question.
well, we'll think there's two questions probably.
Yes,
The
yeah.
second one is a big one. Yeah, Bill, do you want to take a first stab at it?
You bet. So in terms of how you get paid, so it's all done on chain. You come with your wallet, you plug into our interface page, you plug your wallet in, and you deposit a stable coin into one of the existing funds that's on there. And when your money goes to work, it gets paid back to you in stable coin, comes back principal and interest. And so we think eventually there will be folks that will facilitate this through APIs into our platform. That's not currently happening in any scale way. So right now it's individuals bringing their own wallets, but we think it will happen in a derivative fashion through neobank and fintech interfaces where people are already doing some of their other financial services work. So that's how it happens. Now, if you want to off-ramp it, we happen to be in the stablecoin business. TrustToken, our predecessor named Archblock, was the creator of TUSD, True US Dollar, which is one of the major players in the stablecoin business. So we happen to be experts at how to on and off ramp stablecoins. And so if you want, you can easily off ramp with us out of True USD back into your bank account through very fast processes. So you can get back into the kind of TradFi world, but you can also stay on chain all the time, investing on our platform. So that's on the basic kind of mechanics and how does it work side. Michael, do you want to add to that before we get into the second question?
I want to speak to some of the crypto nerds in the audience. I'm sure there are a few of those. There's a lot of ways to handle some payouts. There's a design question to be had there. Like, do you do with an NFT that signal that sort of represents your loan interest, or do you pay it out to the token itself, or do you have the token appreciate in value and allow people to exit? So from a pure design perspective, for the nerds in the audience, the best way to think about our lending pools is if you were being a liquidity provider to a pair like ETH USDC on Uniswap, where in exchange for you putting in ETH and USDC, or just ETH that then gets split 50-50 into USDC, you get an LP token. The LP token represents your claim to the underlying assets and whatever fees and incentives that might derive from your participation. And that's how we typically think about it. We effectively have you receive an LP token in exchange for your USDC deposit, for example. And now today we take largely stable coins, but we also are exploring taking Ethereum and wrapped Bitcoin and other things. It is literally just a supply and demand play. So we'll build it if there's interest. So simple as that. It's not limited to stables. But today, to give you an example, if you were going to lend into our DAO managed USDC pool, you'd in return get what we call a TF USDC token, which is a TrueFi USDC token representing your claim to the underlying principal and interest of your loan. And then as the loan approaches maturity, on the assumption that it is repaid in full, your token appreciates in value linearly with the expected return at the day of repayment. Now we'll get into what a default looks like in just a moment. But
yeah, just a question about that.
Yeah, shoot.
So you said you get that NFT token. So can I trade that NFT token? So let's say I buy it. I lend to, let's say, someone, a real estate developer. I receive that token that's, like you said, appreciating over time. Can I sell that? And do I need to hold on to it until the end of duration?
Yep, and I want to be clear, we don't do NFTs as part of this. We do a pure token play. Effectively LP tokens, right? And now, can you trade it? Is an interesting question. Trading debt is a hell of a thing in our market. So at present, though the technology could conceivably support it, the regulatory environment can't. And so we don't allow the trade of these tokens for the underlying loans, with an exception that, Bill, maybe you want to add a point.
So the exception is, and I referred to this obliquely earlier when we were talking about the regulatory side. So we have partnered with a U.S. broker-dealer who is one of the very few broker-dealers that has the very deep sub-license permissions to trade and settle in digital assets. And our partner is called Oasis Pro Markets. And we partnered with them because when we were trying to create this functionality, we realized that the SEC has put a kibosh on creating these licenses, and the folks at Oasis were smart enough to get it and get through early. So there are major financial institutions who would like to have this capability, and they can't get it right now because of the slowdown and the freeze here. What that gives us the ability to do, and the important thing is the ability, and when it actually starts happening is going to be a little bit further down the road, is we are able to take people's TF tokens that represent their interest in the portfolio and trade them on an alternative trading system, an ATS. And I'm not trying to go too deep into this terminology, but that is a sanctioned marketplace, private marketplace, sanctioned by the SEC. Now, you got to have somebody who wants to come trade with you. And so that's the part that we're going to work on to create that liquidity. But yes, in a U.S. regulatory compliant way, you can deposit in that fund, and eventually you'll see the ability to make those trades. This is different than trading in equities, which is back to the point Michael was making here, which is because equities, there's price discovery, and same thing with crypto assets. There's price discovery, and you can see the bid and the ask and the supply to sell and the supply to buy. In debt, it's much more complicated because you've got references back to the underlying credit and where are interest rates, et cetera. And so that's not going to be as efficient of a market, but there will be a trading market, and we're very excited to be building the infrastructure and the scaffolding that will provide that.
And I'll wrap with these TF tokens by saying the TF tokens do enjoy liquidity, and you can exit into your underlying assets at will, provided one of two things. Number one is if there is sufficient liquidity in the lending pool, the lending pool is very happy to buy your interest in the underlying debt, and your underlying loans, rather, in exchange for USDC that might be underutilized. So we try to run our pools at 80% utilization, 85% utilization, so that there's always that liquidity bound where you can effectively withdraw from the vault. And that's what we call liquid exit. That's been super, super popular. People love it. And when that is used, the fees actually get paid out to the lenders who are still in the pool. So there's a small fee to exit, and the beneficiaries are those who are still active. On the other side, if provided that there's not adequate liquidity in the lending book itself, there's a secondary market being run, I believe, today on Uniswap with TF-USDC and USDC parity. Where TF-USDC obviously has priced in the appreciation of the lending book, and so it is priced higher than USDC itself. You can sell the TF-USDC with some nominal discount because of the liquidity that you're taking advantage of back into USDC, and that is something we've been able to achieve in a compliant and regulated way. It does not represent the debt; it is a claim on the loans in the full portfolio. We've been comfortable supporting that to date, and it's been heavily used. And we're actually proud to say that we're one of the few credit protocols or unsecured protocols that has the ability to have liquidity on your loans. Some of our competitors, you lock that stuff up for up to 2 years. And without naming names, I mean, that to me is a non-starter. because the crypto market in 2 years, like, the market's a whole different ballgame. So I can't conceive of a way to do unsecured lending without the liquidity play for it to be good to lenders.
And just to add on to that point, for anyone who doesn't know, the key to building wealth is being able to lend it and then lend on top of that, or be able to borrow. And if you can't do that, this platform's enabling liquidity on your loans, which if you're doing prior lending doesn't basically exist. So this is another potential benefit of this platform.
Right.
So let's go into bankruptcies, not paying loans. That's obviously going to be a concern because, like, we've heard in the crypto space, Luna, collapsed, Celsius went bankrupt. So a lot of these lending institutions in crypto have had their reputation really hammered this year. So can you explain like how you guys handle it and how you differ from Celsius?
I want to tee this up, and then I want to let Bill get into the nitty gritty. So let me tee this up. So today, like, this is don't hate me for the PR spiel, but let's call it it is, right? So since November 2020, we've done about $1.7 billion in originations, just a little bit under that, almost 2 billion, but not quite there. We've collected about $1.4 billion in repayments. We have had no defaults, no declared defaults, a very strong record of repayments. And we've had 2 incidences of at-risk capital. One, which was really interesting, it was a TPS loan. TPS is a subsidiary of sorts, 3 Capitals.
3 Arrows,
3 Arrows, I apologize. And what we were able to negotiate with them, with a credit committee that's sort of a blend of in-house people and DAO people, is early repayment. We successfully collected early repayment from TPS and avoided any default proceedings there, any liquidation proceedings. So that was an awesome thing to happen. But it's to also suggest that, like, we're super engaged, we're very proactive, we're actively managing this lending book. We have expert people in the room to actually settle these things, and we've been able to get good results. The other thing that was really interesting is we had a loan out to, I believe, Blockwater, a little more of a risk-on DeFi fund. Things may have been a little hairy. I'm not going to speak too much to it because I wasn't privy to much of that conversation myself. But what we were able to do is we were able to do the first ever on-chain restructuring. We're still in the repayment process. We're still going through that. So I don't want to go over here and shout from the rooftops about our successes and claim the first ever on-chain repayment and flag that banner yet. But that was another way of averting default. We were able to negotiate with on-chain loans already outstanding, a repayment process that seems to be working for them. And they've been paying us every week to an address that's public. So we actually are collecting on those funds. Hey, credit is a risky business. Defaults are priced in. That's why the rates are so high. We've been very lucky to avoid any of them. Not everyone in our industry has, both on the decentralized side and some of our competitors, but also obviously on the centralized side, we've had some really important names struggle, to say the least. And that's why I think the transparency of this whole thing, on-chain lending, actually shows you where the money's going, who has it, how it's levered up, where the exposure is so important. That's been something we built in. I'm not one to claim that we'll never have defaults. Sometimes I get a little aggressive with our marketing copy that we've had, perfect record repayments. But we've been very good to date. We're very engaged with it. Even in today's, sort of winter mute situation, we're very, very engaged with them. We have an opportunity for credit facility with them. We're very hands-on there. And without saying too much, the credit committee is very active in handling that, and so far so good. So that is, the PR spiel. Thanks for giving me the space. And I want to hand off to Bill to kind of talk about the nitty gritty.
Well, first of all, that was excellent, Michael. And I'm not going to add a lot because I think you really covered it well. I just want to reemphasize, show me a lending business that doesn't have defaults, and I'll show you a business that hasn't gone through a real cycle yet. It just means they have not, because people talk about cycles, they always assume it means an economic cycle. I'm talking about the actual specific cycle to that credit strategy, because it will happen. And if someone doesn't have any defaults, then they're really just doing the business of lending somebody their own money effectively, because there are businesses like that. But it's where, here, deposit $20,000 in your account and I'll lend you $10,000. You just borrowed your own money. It's kind of a joke. So that's number one. So we will have defaults, and Michael made the key point. It's all about the portfolio managers being really expert at it, and people choosing portfolio managers to deposit with who have the expertise to deal with it and bake that into their strategy. The thing I want to emphasize, though, is that I think we hit on, but just to make it even more clear, the major lenders that ran totally into the ditch that you mentioned, they were doing everything off chain. And so Celsius operating off chain, Three Arrows off chain, et cetera. You couldn't see what they were doing, and they were effectively growing assets under management because they were trying to raise their valuation to satisfy their equity holders. And so we don't have that same dynamic here because we don't make any equity dollars based on how many dollars are on the platform. That's not how this business works. The protocol earns protocol fees to have dollars on there, and the individual managers get paid based on how well they manage that capital. That's the huge distinction here, which is CeFi lenders are what failed in this credit cycle, not DeFi lenders like us.
Yeah, true. And Bill, do you want to talk a little bit about the default proceedings, the various steps that happen in the case of a default? We haven't had one yet, and so I don't want to oversell just how battle tested and rigorous this process is. This is the design, and so maybe Bill, you can talk about the design.
Sure. So what will happen when we have managers who have an eventual default that goes into bankruptcy proceedings is that's why our individual portfolio managers have entities, because you can't have a legal claim on someone if you don't have an entity. And so all of the portfolio managers including the ones that are part of our company, because the DAO pools that Michael's been referring to are part of TrueFi and managed by them. They're all as an entity underlying that, because any court in the world where you've loaned money, and we have loan agreements, legal agreements, you have to be able to go into court and say, they had an agreement with me and they didn't pay me. So the steps are that somebody doesn't pay us back. We try and have a private negotiation with them. So you'll see that when we go out public about something, we've already had the negotiation preliminarily. And if we settled it in the instances that Michael's talked about, that means we reached a settlement with them and restructured it to a degree that we can keep them and ourselves out of a bankruptcy proceeding. But if it goes into bankruptcy, then we go in and make a claim against them, and we become part of this legal process. And it's specific to each jurisdiction, whether it's the U.S. or other international locations. And you go into court, and they organize an administrator effectively who says, we're going to figure out what the assets are, and we're going to figure out whether we should keep this business going or whether we should liquidate it. And that's the process that goes through, and that's what our portfolio managers that are coming on have to be expert at, whatever the relevant default or bankruptcy proceeding that they're going to be going into. And so the issue that creates is that that's going to create all sorts of off-chain processes that they have to be good at, but you'll see that going on. The transparency will be is if a portfolio manager has 100 loans in their portfolio and one of them is going through restructuring, you'll see that, it'll be declared, you'll understand, and you'll be able to read about what's going on as you understand what recovery they're going in and pursuing through the legal process. I don't know, I think that's about as deep as we want to get into the whole area of restructuring and bankruptcy court, because that's what a lot of people think is a non-pharmacological sleep aid, talking about that process. Sure. But so we won't go any further.
Maybe what I can do is I'll tell you a little bit about the governance design. This is, we're still early into this. There's things that have to be done to move over some of these processes to the foundation or the decentralized MLAs. But I figured I want to tell you what the design is, because actually, not just to talk about it and speak our books, but we actually want feedback on this stuff. This is like, we're at the bleeding edge here. We don't claim to have the best practice here. We're excited to work with some folks to design the best version of this. And our in-house legal has been working night and day on this stuff. So I figured at least share our progress. In the ultimate design, in this sort of TrueFi to be, which we're so we're well in the process of. The first thing is the loan agreements that will be signed will be ideally signed on chain itself. So these are what we call decentralized master lending agreements. They'll be signed by the lender and the borrower to commit before they go into the pool what it is they're getting themselves into, and that really creates a standard operating agreement between all parties as they go into this. So those lending agreements will be enforceable. So in case there's default, there will be collections. Now, who handles collections in this decentralized world, right? Well, the idea would be that the DAO would effectively elect a collections party, a party to represent them in this sort of claimancy. The most obvious one would be to work with the TrueVi Foundation. This is we have a funny little design choice that we've made to do this, but it effectively is a foundation that acts on behalf of true holders. It employs or at least has a few representatives that are elected by the DAO. That DAO does things like handles taxes and legalese and what have you, and it would in fact pursue claims if they were the designated party. That designated party would then potentially use some of its treasury to compensate the lawyers in-house or out-of-house to pursue the liquidations, and then on any successful collections would distribute those to the affected parties. One of the things that's currently being deliberated is whether those affected parties would be the stakers, who represent a layer of protection against default on the DAO pools and not portfolios. But it would definitely flow down to the lenders themselves. That is definitely something that we've explored. So there's a lot of moving pieces here. The decentralized MLA that acts the sort of binding agreement between all parties, the collections motion that is handled by the TrueVi Foundation or another designated party chosen by the DAO, and then finally the flow of funds that are collected, as well as the implications on stakers who might be affected by slashing in case of a default based on the certain pools. These are all design challenges that we're early into figuring out again, now that we're doing it in a more decentralized fashion. And hey, we would love some input. I'm sure there's maybe a legal mind or two that has an idea of how to do this. So we have a great Discord channel where we can personally participate in this stuff that we might put in the show notes. But hey, this is like the most interesting stuff happening in this field, and it's a niche field of a niche field. So admittedly, but that's the design that we're playing with, and we're well on our way to try and make it happen.
It's awesome. I was hoping you're going to say you're going to hire some guys with baseball bats to go collect the money. But...
We'll see what has to be done. Up to the DAO. I say I delegate it to the
DAO. Could you imagine like a couple of virtual guys, you send an NFT of guys with a baseball bat to collect the money?
Yes, our second NFT mint. Yes, baseball bats.
So obviously there's a lot of focus on the portfolio managers here because you're lending the money to them. So is there going to be some sort of like rating system or credibility system attached with each portfolio manager? So as a person who's lending money, you feel confident, hey, they have a good reputation. If I lend to them, I'll probably get my money back, or more likely to.
So if we're building the marketplace, and this is similar to the analogy that Michael was talking about, if we're creating the Amazon equivalent marketplace for capital or the Shopify equivalent for capital, we don't think it's our job as the runners of TrueFi to pick who the winners and losers are. We think that's what someone from the outside will do, and there's a business model for somebody. Now, in the same way that you go out into the mutual fund space and look at all the different mutual funds, the exchanges that the ETFs trade on, et cetera, they don't tell you who's good and who's bad. Outside services do that. So we think there is a place for that in the marketplace. And track record will speak to a lot of people. So you'll be able to go in on the user interface and say, and eventually the functionality will be more and more powerful. You'll be able to sort. Show me who's had the best, low level of percent loan losses. Show me who's had the best overall performance closest to the benchmark they said they were trying to hit. Like they said, I'm going to return 10% on capital over a long period of time. And then on top of that, we think people will start analyzing and researching them. And so, in the traditional finance world, you may have heard of Morningstar, who rates ETFs and mutual funds. We think someone will develop that. So we don't think that's our job. We're just, here's the grand bazaar. Everybody come open up your booth, which is what I mean by a portfolio, and let the best ones survive. And investors will figure out who's got the best booth, and they'll go shop there for their capital deployment.
Mm-hmm. Mm-hmm. And I think we played around with being the sort of on-chain credit provider with our sort of crypto market maker lending business, and it's a bit of a grind. And ultimately, we are the only consumers of that data in the first place, so we didn't really find it very useful to compete in a whole new space. We're already competing for liquidity. We're competing for loan diversity. So we have a lot of options. We're going to compete in setting the credit scoring system for the world. It was a difficult business to be in. I don't think a business we particularly desire to be in, and we end up just using those numbers for the decentralized credit committee in the first place. So we're the only consumers of that data. When you have this idea, to Bill's point, of who does the ratings are a product because they take work to create, and then there needs to be consumers to consume them. The question becomes like, what is the value captured by the rating agency? And so we didn't really want to be in that business ourselves. To Bill's point, it's not a very easy value capture opportunity. And then to the premise of being the bazaar, there is one nuance that is hardly an A through F grade, but it is a pass fail, if you will. And that is the you might say wisdom of the crowd in terms of the TrueFi community, because the TrueFi community does at the end of the day have the final say about who gets listed to the TrueFi front end itself, right? You can use the pipes, you can use the infrastructure, increasingly so, as we make it more and more public and more self-service and more and more well documented. You can use the pipes to run your portfolio. But if you want to run that portfolio to the TrueFi front end, where you're going to get liquidity or at least lender visibility, then you need to go through the community. And that does present, some interesting challenges in telling your story and getting sort of the political buy-in of token holders who say, yes, I want to see this product there. And I want to potentially put either my capital in or designate that is a thing that I agree with people putting their capital in elsewhere. So it's a pass-fail grade. It's not a rating scale. It is not done by necessarily an expert committee. It's done by more of the wisdom of the crowd. But it's an extra layer of wisdom that we like to say, adds a little extra value to our selection criteria. But at the end of the day, TrueFi will choose how that evolves. TrueFi will choose to see if there are letter grades. TrueFi might choose to designate a particular rating agency in some eventuality where a few of these compete as being the rating agency that they choose to display on a front end. So we're open to all these things. I don't think it's necessarily our place.
That's greatly to elaborate, because I know Morningstar and all these, it's a whole lot of work, right? Because they need access to tons of data. And that brings me on to another point I have is, who's going to own the data? How accessible is it going to be on the blockchain? Because you did say it's going to be stored on the blockchain, but in order to make, investment decisions, you'll probably need more than what's just on the blockchain. So how will they have access to this data?
Well, I think each individual portfolio manager is going to decide how much information and data they want to put out. And obviously, more information, more data, we think will be rewarded by more dollars or more stable coins, rather, deposited into their funds. And so, for instance, the founding funds, the DAO funds that Michael and I both referred to several times here, each individual loan is on there on the UI. You can see what loan is made, what's the rate, what's the duration, who is the borrower on there. And so some people may decide to put more granularity than that, as long as their borrower agrees with that. So it's really up to them in terms of deciding how much is out there. But if it's on the blockchain, it belongs to the public domain. I mean, we're not going to put any constraints on it, and so it's just up to the portfolio manager on how much they want to put out there. And we think you'll get rewarded for more transparency. If your expertise is in how you judge the data, that you don't have to put out there. You don't have to put out your spreadsheet and how you crunch it, but putting the data out there for everyone to see what decision-making levers you look at, we think will be rewarded.
I agree with that. I think that if you want to really sort of a mental model for this, I will present sort of the idea of an X and Y axis, where on one axis you have the amount of transparency that the portfolio manager has opted into, and on the y-axis you have the amount of liquidity that's able to attract. And there are benchmarks along the way. There's offering very little data, but just a story of how you're going to allocate the capital. There's going to be performance data as you actually make capital allocations. There is being a little more open with your books, but maybe to a select few people who maybe want to put in a minimum amount of money, which would be data room access, that kind of thing. And there's some hypothetical peak level of transparency where you're really open with all your books, your allocations, your loans, your borrower relationships, and what have you. And I think every portfolio will actually find some, you might say, level on this XY axis of the adequate amount of information to give to achieve their desired level of liquidity. I think so far we are largely, I would say, sort of in the bottom quartile of that. The amount of information that is presented on most portfolios is performance data. It is the thesis of the fund, and it is the active record of repayments of outstanding loans. But I could see a world in which, as more money gets in here, as the book of lenders starts to include more institutional capital that might have higher benchmarks for the kind of data they need to make capital allocations, and they have more capital with which to do it, making them very desirable targets for more transparency, that could shift over time. So we're early days, and I think the quartile will begin to move in the upper right quadrant over time.
Got it. And this data provided by the portfolio managers, is it stored on the blockchain, or do you have to like contact them each individually to get it?
Depends on who they are. Sometimes it's, if you go on our user interface and it says this is a fund, I'll pick on one of our favorite portfolio managers, Chorus, who is on there managing developing country fintech investments. It's effectively, you see who Chorus is, and then you go to their UI and their website, and you can dig into who are the managers, what is their strategy, et cetera. Now, are they giving you individual loan level visibility? They're choosing not to, but you can see their track record, you can see how they're doing, and you can see what they did before. So it's up to the portfolio manager.
Got it. So right now, like I know you're US based. Are all your portfolio managers currently US based, or do you plan to expand internationally? And what do you need to do to your business in order to allow it to, expand internationally?
Well, first of all, I want to clarify that we have a lot of folks who reside in the US. We also have a lot of team members outside the US. Our engineering team is largely based in Warsaw, Poland, where we have a big base. Our customer success and our KYC and AML and operations team, large a portion of them are in Dublin, Ireland. So we're very globally based, and then we have other team members spread around. We also right now happen to have some of our portfolio managers in the US, but we also have a bunch of them who are not based in the US. The Chorus team, I believe the prime portfolio manager is based in Africa, which is very close to one of the core markets that they're lending into. And a lot of the loans that we're making are out of the different funds are being made to folks that are based all around the globe. So our business is very globally oriented. We do have a number of portfolio managers who are based in the U.S. right now, but we're open for business for anyone all around the world. And we think, frankly, a lot of the demand for capital will be for outside the U.S. The U.S. is a fairly efficient capital market. So we think there will be demand here, but we think there'll be more demand in emerging markets and around the world for the type of risk-on sort of things that our lenders are looking for.
Mm-hmm. Yeah, and I'd say besides the desirability of the investment opportunity as deciding, the kinds of jurisdictions we work with, and notwithstanding sanctions and the kinds of regulations that we have to comply with as a protocol and as a business, one of the other things that I think maybe doesn't get as much attention as it should is the enforceability of lending agreements. Because it's of no interest to the protocol nor to Archblock to service a jurisdiction or a borrower or lender that does not operate at a jurisdiction where the agreements that they sign are going to be enforceable. And that has the constraints of both the global law, but also the enforceability of our ability to get the kind of legal counsel and run the kind of process that actually would see money go back into the inflows. So I would classify the latter thing as sort of a business maturity problem. And there's like stuff that we need to do to be able to service collections. And then there's obviously the global rule of law and, the various like ease of doing business elements that, make certain areas more desirable to invest in others. But you got to say, that also makes sometimes those yields more attractive. It is at the end of the day, like the risk on component. It's just a layer that's baked in. So it's interesting to think about, like, the trade-offs you make around the ability to get your money back. But it is something that I think we probably understate if we think about like the greater macro of the kinds of things we could service.
Absolutely. So this is actually going to be a little tricky question, but I wanted to ask it. So obviously the US, geopolitics plays into who you can lend to. So right now, Russian citizens are under sanction from their invasion in Ukraine. So let's say I am an American who's lended to a Russian company or entity. How would you guys handle that? Or do you have any custody to actually handle this?
So, look, you're asking a great question. Right now, our KYC and AML effort requires that we make sure that we are not doing business with someone who is in violation of major countries that are sanctioned, because a lot of us live in the U.S. and other jurisdictions that care about that, and we don't want to go to jail, and so we're just prohibited from doing that. Let's put aside whether we think that's good policy or not. That's just good self-preservation, right? I mean, we are subject to the laws and where we do business, and that's it. So the example you just described, we would not be able to have you be a portfolio manager. If you were a portfolio manager and your strategy was to lend into Russia, you would not get past our KYC AML. And no sanctioned country works for us right now.
Yeah, the reason I ask this is because that's obviously going to be a concern for any investor, right? It's like, hey, I put some money and I realize this portfolio manager has some assets in Russia. Now I'm in trouble, right? So I love how you guys are handling this and protecting people that way. And so is this just for the ones that you manage through your company, or is it in general?
Well, it's in general. So theoretically, we could have a portfolio manager who comes and applies to the DAO for being listed on the front page of the UI, et cetera, and they could run afoul of the laws. But they're going to have to make representations about what their strategy is and what their compliance level is when it comes to them getting through the DAO process, et cetera, and being approved. On the Archblock side, we're not going to work with any portfolio managers who don't, literally sign up for that level of compliance and from a, please assure us that you're not doing business with terrorists or sanctioned countries, et cetera. So, but on the DAO side, I assume on a governance standpoint, and this again is going to be up to the DAO to define, that they're going to require people to make representations about that. And if somebody says, no, I'm going to, take a lot of money and support some country that's got an awful human rights record and is sanctioned, that they will not be approved. Can't stop them from using the underlying code, but you can stop them from being on the UI and being affiliated with the DAO and with the names that we have.
Mm-hmm. Mm-hmm. Yeah, I wanted too much there, but to say that the DAO has been thus far pretty rigorous in its portfolio manager selection. Most people are getting largely no's, not yeses. And so if there's a red flag like that, then I can't see it being passed. Bill's right. You can't, once the genie's out of the bottle in terms of the infrastructure being made public and open source, it's hard to put that back in there. But I can't see the DAO being, that lenient when it's already so rigorous.
And that's why you established that distinction, right, between the DAO and your company, because you didn't want to expose yourself to that liability if someone uses that platform. It's like, hey, we're not the owners of it,
It's open source software, and obviously there's a lot of examples of what you're pointing to there going on right now, where people are saying, well, wait a minute, you created this, and so you are responsible for it. And our answer is we'll be very clear about what we are responsible for. We're responsible. The DAO is responsible for creating and modifying the code and the UI. But anybody can come grab open source software and do whatever they want with it, and we can't stop them. And then it's up to local jurisdictions to try and enforce something against them if they're using it for malfeasance.
Yeah, a perfect example that comes up recently is Tornado Cash and what happened to the developer who created it. It's like he's not at fault. It's just that criminals are using that platform, and you definitely don't want to jeopardize yourself and put yourself in a position like that.
Absolutely not. And I think people will watch with great interest what happens to someone who created something like that and then it went off. I mean, it's like saying somebody created the design for a handgun and then somebody else went and took the design for that, put it in their own manufacturing plant, and then gave it to somebody who did ill will to that. Did the person who designed that originally, do they have liability for that? How does that make any sense? And how does that, how does the world work like that? So we'll all watch with great interest what happens there. But if somebody designs it and then keeps their hands on the process, it goes to manufacturing and then goes to utilization, then you got a different story.
Yeah, there's a whole like kind of worms here we can explore with 3D printed weaponry, which is now getting a lot more traction in, there was this sort of anarchist that popularized it in the first place, and he had a fairly poor life path thereafter. But once the genie's out of the bottle, these weapons are being modified for further use. And what's interesting too is how they're being utilized. Everyone seems to celebrate the Ukrainian resistance forces using 3D printed weaponry to fight,
Yeah.
their sort of de facto oppressors. But then when you have, a junta forces or local guerrilla, starting to use those weapons in a way that is thought to be sort of morally bankrupt, then suddenly the conversation is a lot different. So, there are analogies to be played with. I think we're actually, thankfully, not in the market of military goods, nor do we seek to be. But this is the age-old questions of like, is fire a good technology when you can use it both to cook your food and burn the house down? So we hope to be on the side of good, and we have thankfully a morally competent DAO, which has been very rigorous, and a really good sort of patron in Archblock, which is sort of started us off on the right foot from the start and remains hands-on.
Are you talking about Defense Distributed? I was watching a couple of
Yeah.
interviews with Reason TV. Is that the one?
Right. Yeah, that's the sort of age-old guy, sort of, I think, out of Texas, that was the very strong libertarian slant. But then, since then, I think he's in jail at the moment for, sort of unrelated charges, you could say. But nevertheless, the idea is long since out of the bottle. He's hardly the only person making sort of military grade equipment out of 3D printers. And things have long since moved past his original designs down to 3D printed bullets. So you're really things have really escalated past there. And we hope to never have to have that moral quandary.
It's such a challenge when you have something like this, because you've created the software, you could have intended just as a thought experiment, because we do have freedom of being able to develop something. If you don't use it for criminal activity, it's not criminal, right? But the path that this sets a bad precedent, especially in the blockchain industry, where you're criminalizing a developer who actually could have had good intentions, and putting them in jail for software that just does something. It's like, yeah, I didn't know how someone was going to use it. So it's like you said, it's definitely something we need to keep an eye on in this space, where the precedent gets established, because I think that's going to determine how we need to build our software for any company going forward.
Another like little interesting thought direction that I don't recommend we take, but it's just interesting for all of us to consider for our industry's sake, is the idea of sanctioning technology itself. It wasn't just Tornado Cash's team that was sanctioned. It was the technology itself.
Yeah.
That had extremely, to me, disturbing implications. The least of which is effectively creating a contagion effect on the wallets that have interacted with the technology, even for non-nefarious means. To the degree that this became moral quandary at unrelated protocols like Aave, for LPs that were providing liquidity to pairs who had simply used the product Tornado Cash for their own, non-nefarious means. To the degree now where you also had, merry pranksters, but you call them many names, sending Tornado Cash tainted ETH to wallets of celebrities, and thereby, blacklisting those wallets themselves. So, in the same way we have to be careful about how we build our technology, I think so too does the government have to be careful about how it regulates them. Because there is too big a hammer to swing in some of these cases that eventually creates a contagion that is far above and beyond the intended effect of keeping, shall we say, investors safe, or keeping the American public safe.
We've come full circle, because we were talking about think about sitting in Washington, D.C., and you're a staff member on the House Financial Services Committee. Everything we just talked about is what's in front of them, and they don't necessarily understand the underlying technology or the implications of it. So we're full circle on this. Yeah, we have a lot of educating to do, and their tendency is going to be to say no because they don't understand, not because they're really saying no.
But this is the problem with saying no constantly. You're going to outsource this technology to other countries. So do you really want your competitors out there, like, I'm going to say China, Russia, developing this technology instead of the United States? It makes no sense. So they have to be very careful how they legislate this.
The good news is there are a bunch of champion Congress people and senators who are totally aware of the issue you're pointing to, and they're saying we can't stifle this. We have been a great innovator in the U.S. Let's not lose that edge here. And so hopefully the right balance will be struck. Is it likely to be, on the conservative, go slow side, but hopefully not so slow that we create a competitive advantage for someone else?
And this ties back to the idea of nations competing from a regulatory perspective for brilliant innovators. This has always been the case. America may have thought to be in sort of historically lead from a Silicon Valley and technologist perspective, but I'm not so sure that we per se are in the lead on the cryptocurrency innovator perspective. Some countries have gone far and away, optimized for this. Malta being a funny example. Whether or not they're successful in that is, remains to be seen. But they chose to brand themselves as the home for this. So did Zug in Switzerland and a few other places. They decided to compete from a regulatory perspective for crypto innovators and have to some degree succeeded. And so we are in some ways losing that battle if we hope to be first. And this is not, I think, a step in the right direction in terms of tornado cast sanctioning the technology. That's disturbing to me.
Well, like here in Canada, they've done something similar. So any transaction over $1,000, you have to report where it comes from. And I'm just thinking, like, this rule makes no sense. Like, you're now stifling the amount of money people are going to be sending. Everyone's going to be sending under $1,000. So they're just going to bunch up transactions. And so you haven't solved anything. You just made it harder to send money. That's it.
As I understand it, you can also only buy a certain set of coins in Canada at a certain level of total value for the year. So as I understand it, they picked 4 tokens, somewhat arbitrarily. I don't know why Bitcoin Cash is on the list, personally speaking. But you're like, man, what is Canada up to? Who's writing these laws? No offense to legislators there, but it's like, this feels rather uneducated. And I can't claim America's much further afoot. This is bleeding edge technology, and we haven't done necessarily a good job as a sort of a class of innovators educating our legislators.
Yeah, in Canada, I'm just going to say our government, I don't want to political, but they make very stupid decisions lately and a lot of issues. And
apolitical statement.
Canada doesn't have a monopoly on that. There's a lot of that going around. So
and it doesn't matter what political party is in charge. They just had a long history of doing this. And this is just extending into crypto. So,
well, the call to action is for your listeners is call your parliamentarian, call your member of parliament, call your congressperson, call your senator, send them messages and let them know you care about innovation in the blockchain and Web3 and crypto space.
Absolutely. And Canada's like prime is to be it. Like, we have one of the cheapest electricity sources in the world. A lot of huge mining companies are setting up shop here, and we're heavily invested in renewables. And we already have a large tech industry here in the GTA area. So it's like you have all the ingredients you need to be part of the crypto revolution, but we're stifling ourselves. It's like
there's a long history of great competitiveness in Canada. It has some of the most competitive large money center banks in the world because of very, very proactive and innovative financial markets thinking. So I agree. Canada is primed to be a big player. Let's hope they don't blow it. Let's hope the U.S. doesn't blow it.
Yeah, I think we're being optimistic here, but
I think
let's
we
see
are,
what
but
happens.
let's hope for the best.
So going back, how far along is your Archblock? What have you actually developed? We talked a lot about the idea, the theories behind it. What's in active use today?
So what's in active use today is our on ramp and off ramp that relates back into our stable coin and on chain currencies capabilities. That's something that we're able to help people with right now. And again, because we built True USD, we have that technology in place, and we're able to work with a manager who may be onboarding a stable coin as the investment vehicle that someone's depositing in their portfolio, but they're actually deploying fiat into their end activity. And so we're helping with that off-ramp activity. Also in our KYC and regulatory and compliance area, that's an area that we built up in order to build up our stablecoin business. That is up and running, and we have an ability to evaluate and process entities both on the borrower, on the lender's investor side, but also on people being compliant around that. what we're building on top of that, and this is the part that's to come, is more systematized versions of that. And this is some of the things we talked about before, some of the legal agreements and the ability to have people create legal infrastructure they need for their fund, some of the reporting information they need in order to report to and provide information to their investors. That's all being built right now. That's all on our design and product runway. So if you were a portfolio manager coming to us today, you get white glove ability to come on to the TrueFi marketplace and us get you up and running on your portfolio. But it's a lot of it's manual processes, and we're going to be in the process of turning that more into SaaS software that we will serve up to you.
So it sounds like you have a lot of work ahead.
We got a lot of building. We got a lot of engineers, and we got a lot of work going on.
Absolutely.
How big's your team?
Our engineering team in Poland, and this is a mix of both smart contract engineers and also more traditional programming, is about 45 members over there. It's we think we have one of the biggest, if not the biggest, smart contract engineering teams in the world. We made an acquisition about a year ago of a company called ETHWorks, which at that time was doing lots and lots of third-party business. We were a customer of theirs, and then we acquired them, and they became part of our team. That's where our core engineering team came from, and we're just thrilled. It's an incredibly talented, strong group, and we've got them operating both on DAO projects and on Archblock projects.
So that's an interesting question. Now so they're working on both DAO and the Archblock company, right? Is there a structural difference within that, or are they kind of like flowing in between both?
So we've divided them into teams that are dedicated to one or the other. And so every once in a while might somebody say, hey, can you come take a look at this? And they might cross over from Archblock to DAO work. But we try to keep them as dedicated teams because they're on different missions. Today, those engineers work for Archblock. Over time, you're going to see them migrate and be employed by the DAO. The DAO makes money by having protocol fees, meaning how many dollars are running through the protocol, and they can only afford so much given the level of development they're at. So we at Archblock are funding and curating that. Our goal is for the DAO to be 100% fully operating, and we have the DAO has plans. We have plans for them to get to that level. So that's where it's heading. But we do believe in a separation of church and state, and I'm not sure who's church and who's state in that example, but you get my point. And so we try to keep them pure.
Yeah, I agree. Because like if you intermingle like that constantly, you could get some legal issues saying you're the same entity.
Totally.
So absolutely.
And there is an effort underway to move procedurally sort of larger batches of developers to be full on, contracted by, and compensated by the TrueFi DAO. Right now, there's a proposal underway to move 5 members of the formerly TrustToken Archblock team to the DAO to be, fully operational under the DAO and to be compensated by the DAO. And have no formal affiliation with Archblock or TrustToken or its parent companies. It's early days. This is a hell of an experiment. It raises all sorts of questions around healthcare and the requisite amount of stability for these people to enjoy a professional balance in their lives, and what kinds of reporting they'll have to do to the DAO to maintain sort of their salaries over time. So it's a hell of an initiative. It's the first of its kind that we've done. But I think it presents an earnest effort to make a true separation between, you might say, church and state. And if this is successful, this 5 will be followed by a larger batch of engineers that might be compensated by the DAO as well. The thing that's a little harder to do is to then build a protocol that is profitable enough to sustain these salaries through its operations. So we've obviously got a lot more work to do on both the governance and operational side to get these people under a productive sort of working relationship with the DAO. But also there's a lot to be done in making the protocol profitable, from sourcing liquidity, managing fees, originating of loans, so that they can actually sustain their operations and their personal livelihoods working for the DAO at large. So I'd say it's the early days. A good effort is being made. There is, a real, true, earnest move of people to work with the DAO itself. The engineering team will probably be the second or third wave But I could see a world in which these are no longer, core contributors from Archblock, but rather are fully, under the TrueFi DAO, working as open source contributors to the project.
And we've uncovered yet another area of where we're on the frontier. If you did a search and a scan against all federal laws and statutes and all state laws and statutes about how do you govern or how do you interact with or recognize a decentralized autonomous organization, you do that today and you're going to come up with nothing. And so we have to create all of these structures and infrastructure without knowing what the regulators may say about that. And so it's exciting, and it's a little bit nerve-wracking because we're saying we're thinking through the way we ought to think about it, but we have no idea how state legislatures or the federal government's going to think about it. Fascinating.
Yeah,
it's fun.
we're inspired by very deep partners of ours, MakerDAO, for example, who they've been doing this for years. They are to arguably on the forefront of governance. Arguments to be made about how effective that governance is that are for another show entirely. But at the end of the day, it's like we like to think we're right adjacent to them. We're right parallel to them, especially how young we are relative to MakerDAO, with the level of decentralization, outside contributions, DAO compensated efforts, and contributors. Governance actions that have a material impact on the DAO itself, especially those that are not originated just from our own community and core employees. So, this kind of like there's a Howey test of securities. What's the decentralized test? And so we have a model that we use in-house that I won't speak to here, but it's cobbled together from regulator disbursements, from best practices, other protocols, from the intuitions of our legal counsel, and I could say we're doing our dangest to make it work.
With regulatory compliance being so important, how big is your in-house legal team?
Great question, and the key qualifier in your question is in-house. Okay, so our in-house team, we have 3 lawyers, and they are unbelievable, and they are massively overworked. But we have to use a lot of outside counsel, and that's from all sorts of firms, all the way to traditional, what I'll call white shoe, traditional Wall Street oriented law firms, to firms that are in Washington, D.C. on the regulatory front, to all over the place. So what we like to say is we're putting the children of a lot of lawyers through college, through the legal expenses we have out of house. So direct team is pretty small. The amount of lawyers working on the problems for us is quite big. It's dozens of lawyers.
And because you mentioned that, obviously lawyers are extremely expensive, especially those ones that you mentioned that work at premium top end firms. How do you, obviously developers are also expensive who develop good software, good engineers. So obviously the cost is very high. Mm-hmm. How do you manage that, growing your company, having these huge expenses as well? That's very difficult.
It is very difficult. It's a great question. So first of all, a lot of these law firms, even the most expensive ones, have recognized that if you were Google's lawyer on day one, they turned into an amazing client. In fact, there are some law firms that made their whole practice off that. And so they have fee models that are made for startups. And at the end of the day, the DAO is still a startup, and Archblock is a startup. And so a lot of them are using much more early stage fee models for us. And we're very grateful for that, because they're betting on us, and not just on us, but a lot of other companies that look like us, on the future, because they want to hitch their wagon to the next Google or whatever. So that's one of the important ways that we do that. The other way is to create this balance of what can we do in-house versus what do we do outside. And again, I'm going to plug them here, and I hope I know they'll listen to it. I hope they focus on this. Our legal team is awesome. We have a lot of values at Archblock and TrueFi, and one of them is get stuff done. We don't say stuff, we say something else, but you know what I mean. And the paragons of get stuff done at our company is our legal team. They get more done every day than several law firms. So. Mm-hmm.
Yeah, and I might make an extra little a shout out here. It's painful to say, but at the end of the day, we raised I think, a boatload of money. There was an era when in 2017, it was the era of the sort of like equivalent of the IBM suit with a pitch deck going to Silicon Valley and raising, $30 million for the next .com. There was an era where I think we lucked into our timing with also great investors behind us, A16Z being one of them, Founders Fund being an early stage seed investor, and then followed on later by Alameda and Block Tower. So we've raised now multiple rounds of funding, all on token sales, never on equity sales, which is interesting as well. And I'll be shy to say it, but I think it's true. A lot of that has gone into the legal side. And I won't name numbers. I don't actually have them, but I think it would be of no surprise that companies that raised money during that era spent a fair amount of that money on legal. Thankfully, the business, especially the stablecoin business, is quite profitable. Archblock does not have a huge burn. We manage our treasury well and have gone through plenty of bear markets. We have an active trader and quant trader at the company as well to manage treasury. So Archblock is very well capitalized. And has a nice balance of spend and burn, as well as sort of inflows from its business units. And for how big an expenditure legal is, the company right now is designed to be able to sustain it, thankfully, with plenty of runway, and a protocol that's hopefully moving towards self-sustaining as well.
I could imagine your legal team must have interesting questions all day. So yeah, there's no rules or legislation on this. What do we do? It's like, let's just think of what the government would do.
It's literally like startup lawyers. You know what I mean? Like there's lawyers and there's like startup lawyers, and startup lawyers have like startup founders, where you're doing stuff that there's no precedent for. And so, we've been very lucky to hire those. They really do amazing work without precedent. They really are, doing the work that might eventually be written into law in earnest.
That's amazing. So I'm going to ask you this question because there's a lot of entrepreneurship currently going on in the crypto space, and a lot of people who are eager to, jump in and get involved in this space. What would you say are the biggest challenges and the biggest characteristics you need to succeed in crypto right now as an entrepreneur?
Michael, you go for that.
This is a hell of a question. I mean, I could start anywhere. I think threading the needle. There's like so many interesting answers here. One of the things is actually building a business that is a business that isn't built on speculation. This is actually a very difficult thing to do in this space because many protocols have been built without a true business behind them. And the most earnest way to do that is to modernize an existing business using blockchain technology. Blockchain technology has been, pitched as the solution to everything from, Airbnb fees to actual, lending, which is a much more, earnest, honest to God business. So when I think of like what is a sustainable thing to build in crypto, I like the idea of modernizing an existing business with blockchain. That's probably the first thing I would do, like literally building a business. The boring element of that might mean having to deal with regulation or having to do something that may not get traction as quickly as, say, an NFT project or something like that. So but that being said, if you want to be a founder in the space and you don't want to just capture the easy money, of which there is a lot less now that we're entering a choppy time in the market, then I would really try to find a place where you can modernize something being done in the world of finance, where I think there's a lot of business elements that could be improved in insurance, buy, sell, lend, borrow, trade. There's a lot of like really interesting businesses to build there. And I'm less bullish on things that are pure sort of speculative plays or pure vanity plays, like NFTs, which I think there's some interesting things to be done in NFTs too, like modernizing contract law or real estate ownership or car law, and ownership. So I would probably say there's just so much surface area to cover this question, but I would say if there's anything, I would say build a real business, use blockchain technology as technology, not as a equivalent of a .com back in those early Silicon Valley days, but truly use the technology and build a business, not just do technology's sake.
Well said. I don't think I have anything to add to that. That's great.
What are some of the personable skills you would say to succeed in this space? You mentioned like business ideas, but What does it take as an entrepreneur? Give them an example of like some struggles you had to go through.
Yeah, I might take another stab at this. Possibly the most underappreciated skill in this industry, because we've gone through a round of engineering excellence. And I'm biased, I'm speaking as a marketer here, so I'm kind of talking my book here. But I think that the ability to explain oneself, and not just to do it in a way that is parsable to the common person, using analogies, storytelling, being personally charismatic on stage and off stage, being able to inspire your own team and giving them a sense that you're working on something that actually is going to change the world versus make it cheaper for developers to report their analytics. These are like skills that I think have been unnecessarily underrepresented in crypto, because it was thought to be this infrastructure field like we talked about earlier, and that it requires these people who are going to get their hands dirty in the trenches building server rack equivalents. But we're entering a phase now where crypto is beginning to enter into adoption phase. There requires a level of charisma and explainability that is going to be needing to appeal to both the institutional side of this, so the more buttoned up and presentable side of things, people with tie-dye shirts with sort of more of the hippie flavor, which I sometimes subscribe to, will have a hard time making Wall Street sales. But at the same time, it requires being able to explain to the common retail user, which is used to products that you'll be competing with like Cash App and Venmo, that are designed for a very common retail user, like that spends their days on TikToks and YouTubes, that are designed for retail. So when I think the key word, it is communicability. And that word speaks to both institutions on one side in a more buttoned up professional way, and it speaks to retail on the other side, being able to communicate something clearly and effectively, as much as it does being able to speak to your investors and your team, getting them inspired about what you're doing, even when it might be a boring technology at the onset. So communicability is this one key skill set that I want to see more of in crypto. It's the thing that's holding us back from the adoption we could see today.
We've all drawn the parallel between where blockchain is now and the early internet. And well, with the early internet, we had the .com bubble, and now we have Luna, Celsius. Do you see where are we in the I guess in relation to a .com bubble for blockchain?
I'd love to see Bill take this.
I'll take a shot at this because obviously I led off with my FOMO about it. I think we're earlier than people realize, and I know we all want to ascribe the exact same kind of volatility path to it. And so while this meltdown that's going on right now, a lot of people say, oh, this is our .com moment, our .com bust. I'm not sure that's fair. What's going on right now is a macro meltdown that we're getting affected by in the crypto and the blockchain and Web3 space. My orientation is I would guess that we're sort of 95, 96. Kind of equivalent time frame. Amazon has just been created back then, to put analogies here. People are still making a lot of mistakes. A lot of stuff is broken. I don't know if you remember trying to do well, sorry, y'all are all too young. I'm sorry, I've got to say this. When you first tried to do e-commerce on the web during that period of time, it just didn't work. It just broke, or somebody stole your credit card, and next thing you know, you had to change your credit card number. We're having those things going on here today. In fact, I have one that's that hopefully is old news now, and we're well past it. But one of our big borrowers from one of our founding funds, Wintermute, got hacked to the tune of $160 million in the last 24 hours. I mean, that feels very early understanding of fundamental technology. That's why I would point back to this. It's 95, 96. So what does that mean ahead of us? It means it's not clear who the early winners are yet. And there's a lot of folks who were early winners in the internet that then weren't later winners. And then there's tons and tons of people that are second and third derivative innovators that are yet to come. And so I think we're early innings. I mean, some people just say the national anthem has just been sung, to put it into a baseball analogy, and the batter is just about to step into the batter's box. So I hopefully people take that as encouraging too. You're not late. Get here, get curious, bring the skill sets Michael was just talking about, because this rocket ship has yet to go. That's my take on where we are.
I totally agree. I would use the analogy also. Like, I know a lot of people saying Ethereum is the future. I'm like, to me, Ethereum is like Internet Explorer. Like, it's great now, but there's going to be better coming out. Like Google Chrome replaced them, Mozilla came out. So yes, Ethereum is the gold standard now, but in a couple of years, don't be surprised if they start going down.
Totally agree
Internet
with that.
Explorer is still kind of around. what is it now? It's Microsoft Edge or something like that.
Hey,
I think Internet Explorer or Ethereum.
So whatever,
I was gonna say
now,
Ethereum is more like Netscape.
Mosaic, or I can't remember what the first, what was Mark Andreessen's first web browser that his business
Netscape.
created?
Netscape,
Thank you.
yeah.
So whatever the analogy is, it's ones that aren't here anymore. They were the pioneers, but I agree with you. Our heads are going to spin when we look backwards, and it's always like that. But you look backwards, and you realize how many things we take for granted now, but they weren't invented in the first 10 years of the internet.
Exactly. And there was problems with just like basic stuff in the internet. I remember I watched the documentary where it's like routers would just not work properly. They haven't figured out routers. I'm like, there's just essential stuff we need to figure out on the blockchain level first before we can build, concrete, sustainable applications on it. And we're getting there, but the foundation is not yet complete. That's what I'm seeing.
Yeah.
Agreed.
Yeah, and there's something you said about we've gone well into the opportunities it presents for founders who are really willing to build the infrastructure and then build the first retail apps and build the apps on top of that. But there, I think maybe is an opportunity to speak to the advantage to be gained by folks who are willing to learn the space just to participate in it as pure retail agents, whether as employees or as just users. Because there is, in the same way, you're maybe able to get better deals on PayPal and eBay than you would be able to go to your local free market. There is that delta of advantage you open up in terms of, let's say, yield that will eventually become more efficient, or the prestige of being early into particular NFTs that you won't be able to realize as the market gets more mature. So for all the delta this creates, this alpha even. This creates for founders who are willing to build it. It also creates it for the people who are willing to simply learn enough about the industry and be able to up their paycheck because now they're working in an emerging field, or are willing to learn the field enough to be able to capture yields that will eventually be priced out by a more efficient market. There is advantages to being on the edge, and they are not delegated alone to the founders in the space.
Well, the analogy I always use is name me an engineer who started working on Google in the early days or Amazon who is poor right now. They don't exist.
It's true.
So you don't need to be you don't need to be a
Sure.
founder. You don't need to be a creator. You just need to get involved early enough, and then you're set for life.
Yeah, I mean that's kind of the funny part. It's like they're probably doing so well that they are anonymous by choice because they don't need to be bothered engaging with the world at large. They're enjoying the fruits of their labor.
Exactly.
The timing
You have
is
secretaries.
good right now.
That's
Yeah.
right.
You have secretaries from the early days.
My gosh. I mean, I heard about the guy who was a graffiti artist at Facebook who got paid in stock.
Yes.
And
Who was
then I
doing
heard
murals on the wall. That's right.
Yeah,
Yeah.
exactly.
Yeah.
There's another funny story in Palo Alto. There's a gym that was offered a corporate relationship with Facebook so that its employees could work out there. The guy said no to stock and instead took cash, and he regrets it to this day. That's the story you don't hear about. The
course.
guys who missed the vote.
Well, that's like the pizza guy, the guy who spent like
Right.
30,000 Bitcoin on a couple pizzas.
That's a great story. If you watch his interview on CNN, you can see like he's sad in his face that he did it. And I'm like,
Yep.
well, like it was only a couple of bucks. You didn't have
That's
to do
right.
it.
That's right.
And the irony is like this also translates like a little further. If we're gonna get to this, we already talked about the pretty guns, so I feel comfortable going to the edgy stuff here a little bit. But like all the people who use the Silk Road in cryptocurrency to buy narcotics or whatever, like those guys are out a pretty penny too. So it goes all the way down. It like the pizza guy is the 0.1%, but a lot of folks have missed the boat, and you can still miss the boat by just choosing to not give a crap about the space now. Right, that's the equivalent today.
Well, I remember like me and Andrew had this dilemma like about a year or two ago. Everyone's like saying, "Oh, mining's over, everything's over." And I'm like, "Whoa!" Like we had an extremely profitable year this year and last year. And even though right now the mining world's going through, I think, which is going to be a healthy change in proof of stake, because now they're going to have to diversify and actually build projects that actually want them that Ethereum never wanted. Proof of work miners. So I think this industry is just constantly evolving, and you just need to get involved somewhere, and you'll reap the rewards of it later. It doesn't matter what you do.
Agreed.
And there's plenty of room for non-technical people. That's also the thing to highlight. Yep.
We
Plenty of
need more non-technical people, because the
I
problem
agree.
is, if there's a bunch of technical people in the room, how are you going to communicate to the masses? You can't.
Precisely.
And
Agreed.
that's the point I think we're at now, where the technology is getting better and better, but we're having issues, talking to other people. That's why we started this podcast, because we realized a lot of people associate crypto with scam. It's fraudulent activity. It's used by terrorists. Like, it's not true. There's many technology applications of it, and we need to provide a platform to actually share these ideas. So to wrap it up, where can people find you? How can they get involved with your project? Give us all the info.
Well, I'll take a first stab at talking about TrueFi. TrueFi is probably one of the bigger Twitter presences these days after a little NFT drop recently. So it's going to be TrueFi, TRUEFI DAO, DAO on Twitter. We post lots of really great content there, and this is where you can dig a little deeper into our light paper, into the protocol itself, into the Discord community, where you can actually participate in governance in a real way and actually shape the future of the protocol. If you're ready to get your hands dirty now, you want to see what kind of opportunities there are in terms of lending, maybe you even want to borrow. TrueFi.io, TrueFi, TRUEFI.io is our website. And there's a direction you can take as a lender on the retail side to participate in our lending pools and our portfolios. And there's an institutional tab where you can explore the benefits of either starting a portfolio or becoming a borrower. Both those places will take you as deep as you want to go.
Awesome.
I think you've covered. The other thing is Michael and lots of other of us are out at conferences. So if you're attending a conference, if you're just digging in for the first time and they're learning, we're there. Hunt us down. Use social media to track us down. We'd love to meet you and tell you about what we're up to. We are hiring now. We're at the stage where we're very focused on what we're hiring for. So there aren't as many positions we're looking for as we were before, but that's also an opportunity. So go on to LinkedIn and other places and hunt down what's open in terms of hiring.
Are you guys limited strictly to Poland, or are you looking internationally now?
You can be from anywhere. If you can work remotely and it fits the position, you don't have to be based in any specific location. And that's why I mentioned it. In the U.S., we don't have a centralized office here. We have people all over the country, and some people working outside of our Poland and Ireland bases too, as well, all over the world.
Some of our biggest contributors are actually full remote. And not to sort of put myself in that base, but I've been full remote for 2 years, and it's been some of the best time of my career. So it's been just great. I also want to shout out, we're early into the days of Archblock. We're recording this before we've even formally announced it. By the time it goes live, it will be, hopefully front page news somewhere. But there is now an Archblock website, and that's ARCHBLOCK.com. We got the .com, and that's for the more institutional clients listening who maybe want to get their feet wet with DeFi. Bill and team can help you out.
Absolutely.
Awesome. Well, we appreciate you guys coming on to the show. We wish you the best. If we do see you at a conference, we'll make sure to come up and say hi and have a chat.
Please, if we don't do it first.
Yeah, if you guys don't see us first.
On person. Thank you all for having us. This was a
what a conversation.
Yeah.
Really, really great. Covered a lot of really awesome topics, and I really appreciate you guys digging in so deep. Thank you again.
Of course.
Thank you.